Welcome, guys. I just want to explain to you today this thing called basic earnings per share. Right now, you will see here they're talking about basic earnings here, what it entails. Right, basic earnings is a ratio. This ratio it tells us basically what it measures the interest of each ordinary share. Now, it tells you how the share is performing. Now it tells you the return that you as an ordinary shareholder is going to get based on the performance of the company during that year. Right. So how do you calculate this thing? Here it tells you that basic earnings, it's basically earnings attributable to the ordinary shareholders by the weighted average number of shares. In short, it says you take earnings, you divide them by the weighted average number of shares in that year, okay, to calculate it. But now the most important thing is that you need to know how to calculate this basic earnings. And you need to know how to calculate this weighted average number of shares. Let's start with the basic earnings. Right. Basic earnings, you take profit, it's after tax, you less fixed preference dividends, then it gives you the earnings attributable to ordinary shares. That's the basic earnings that you are going to use here. Right. But for now in this calculation here, I've excluded what we call participating. You'll see when we go to participating, we will expand that calculation. Okay. Well, I've excluded it at this point in time, but as we go along, I will show you that there's addition to this, basically in addition to this calculation. All right. Now, if you are dealing with this situation, obviously this one we can get from the statement of profit or loss and other comprehensive income, which we use to call income statement. So you less fixed dividends, fixed preference dividend. Preference shareholders, meaning preference dividends themselves, comes from these shareholders. They have more rights than ordinary shareholders. Right. Now, it is very important when we are dealing with this fixed preference dividend to understand that preference dividend can be redeemable or non-redeemable. Or preference dividends can also be cumulative or non-cumulative. Let me start with this one. Right. What does it mean? Now, if they are redeemable, it means at some point they will be paid back. Meaning, if I'm an ordinary, sorry, I'm a preference shareholder, and my shares are redeemable, at some point in future, the company will pay me back that money that I paid, and they will take back their shares. Okay, you can see here it says it means the capital amount will be repaid to the shareholders and the shares returned to the company. So they will pay me and take back their shares. They are redeemable. Right. Now, if we then say they are non-redeemable, it means the company will not take them back. If they want to pay me, they want to take the shares back, okay, in future. So now that is redeemable. Redeemable, they will pay me back and take their shares. Non-redeemable, they won't do that. Right. But for the purpose of financial accounting 3, the issue of redeemable and non-redeemable is irrelevant. It doesn't affect your solution. It doesn't affect how you do things. You can just ignore it when dealing with a question at this level. Okay, it doesn't affect anything. Let's then deal with this one called cumulative and non-cumulative. Right. Cumulative means if the company, it's this one here. It means if the company does not have money this year, let's say this year they say to you, we don't have money to pay preference dividend. You still less it here. You must still less this amount if they are cumulative. But if they tell you that they don't have money and these are non-cumulative. If they don't have money, these are non-cumulative. It means here you put a 0. They are non-cumulative, you put a 0. But if they're cumulative, you put that fixed dividend to them. Okay, because when they're cumulative, they don't lose their right. You must always pay them, you see, whether you've got money or you don't have money, right? So let's then now try to apply this in a practical example based on your handout that I've given you. Let's see. Right, here's example 1. Right, it says the company was incorporated here, 2010. They've got here you see the wording here, cumulative. They won't lose their right. Whether you've got money or you don't have money, you must raise them. They are non-redeemable. They won't be. The shareholder won't be paid back the money, and the shares will never be taken back. Okay. So, but for the purpose of this, you must always remember that, like I said, you can ignore non-redeemable or redeemable. It doesn't make any difference. So you must. The return is at 12%. There are 100,000 shares at 1 rand. So ordinary 75,000, no par value. Let's do it like this. It means the value of the share is not, nominal value has not been decided. They can be issued at any amount. So you are given all this. This is your abridged statement of comprehensive income, where you are given the profits. Now there's additional information. Ordinary dividends were declared for these years, 10,000 for the current year and 8,000 for the prior year. Right. Okay. Now, here they tell us on 1 January 2014, the company issued 20,000 ordinary shares of no par value. So they keep giving us all this information. Preference dividends were declared and paid. There are no any other components. Now, what is very important here is that when we are dealing with EPS, especially at this level, and we're giving you a question, always read what we say you must do. You see, we're saying prepare. Let me just try and highlight. Prepare and disclose. So meaning do the calculations and give us the disclosure of basic earnings per share and ordinary. So we're asking you only for 2 things. These. Don't give us things we're not asking you. We are only asking for the 2. The answer must relate to the 2. Right. Now, since we explained that basic earnings, let's start with basic earnings. Basic earnings, it is the earnings attributable to ordinary shareholders divided by the weighted average number of shares. That's what we said at the beginning. So let's start this thing. Let's start with the earnings, the basic earnings. Here are the earnings, right, is given. Now, we said, let's start here. Here's the calculations for earnings. All right. So we said earnings, the earnings here, you must less, let's do the less part, less preference dividend, right? Now, for both the years, like let's calculate this preference dividend here. Right. What you do, you say 100,000 number of shares, the preference one, multiply by 1 rand, that gives us 100,000. Now I'm talking about the money, it's 100,000. Then you multiply by 12%, right? So 100,000 times 12% is 12,000. Okay, so you will see here, it's clear, the reason why they are deducting 12,000 here, right? You will see they are deducting 12,000. Now, I'm even showing you here underneath here how these preference dividends were calculated. Okay, so like I've explained at the top. So the preference dividend is 12,000. You less that, and then it gives you this amount, which is earnings belonging to ordinary shareholders. So we've calculated that part. You'll see here at the bottom, when we're calculating basic earnings per share, you'll see here's 198, which comes from here. Here's 123, which comes from here. So we've calculated the basic earnings, right? What is the next thing in relation to this thing? It is the number of shares now, the weighted average number of shares which we are dividing with, okay? So this company started with 75,000 ordinary shares of no par value. During the year in July in 2014, 20,000 were issued of no par value at market value. Now, these shares, we call them shares for value because there's money that was paid for. You see, shares of no par value at its market value. So there was money given to the company. There was value given to the company. Okay. We call them shares issued for value. Now, when shares are issued for value, you must look at the date when they were issued. You see, like this one is 1 July. So it means these shares in July were there for the whole month of July, August, September, October, November, December. 6 months. They were there in that year, 2014. So you must always pay attention to that fact that when shares are issued for value, when were they issued? So these ones were issued for value 6 months into 2014, right? So they will be there for 6 months in 2014, right? Now, let's look at the next part of this calculation. Here, right, at the beginning, 1 January, we had 75,000. You'll see there's 75,000 across the 2 years, okay? We started with 75 in 2013. It was still 75 in 2014. Now, here's this thing of cash issue or shares for value. These shares were issued 1 July. They were 20,000. And since they were 20,000, they are there for 6 months. You'll see 20,000 times 6 over 12. Then you get your 10,000 here. And if you add everything up, it's 85,000. Plus this one is 90. Okay, 75 plus 20 is 95. Then actual number. This is the actual number of shares, the 95,000. But remember, we said we use weighted average number of shares to calculate, which is this 85 for 2014. Okay. By end of 2014, our weighted average number of shares is 85. You see, we are dividing with 85 here, right? In 2013, it's 75. You see, we're dividing with 75 here. And then we calculate our earnings per share. It will give us this and this, right? Now, once you've calculated your basic earnings, it comes here. They must always disclosure. Now this is disclosure. You must always show them here, right? Please do not change amounts when you calculate in earnings per share. Don't change your amounts. We don't want to see a situation whereby when we are marking, we come here, you wrote something, but when I come here, I see different figures now when we are marking. When we are marking here, right? You must always show the same amounts that we saw below in the calculation. Okay. Now, what also is important is that you need to give us here. You see under the notes here. You need to tell us a story of how did you calculate your basic earnings. You'll see that it says the calculation of basic earnings per share is based on earnings of 198 this year and 123. You see, these are the amounts that they're talking about. And we must always see the same thing. Don't change figures. When we are explaining, the figures must always be the same. Even if they are wrong, you carry them the way they are so that we can then see. And then it says, and weighted average number of shares in issue which are these ones. Here they are, 85 and 75. You see this? Okay. So you must also explain to us here what happened. Okay. Now, once you're done with that, you've got your earnings per share, you've disclosed them, and you've shown us the calculation. Now, if we go back to the question, you've addressed this part. This one has been addressed. This one, it has been addressed. So you just need to address this one now, ordinary dividends per share. So now, you can see here, dividends were declared. Right, dividends were declared. So what you then need to do is to go and look at your actual number of shares. Here is the calculation. Yeah, the dividends declared. Then you say, okay, in 2014, my actual, remember dividends per share, you can use actual number of shares. You use actual number of shares under dividends per share. Basic earnings per share, you use weighted average number of shares. So dividends per share, it's actual. So you see, we are dividing by the actual number of shares. 2013, we are dividing by the actual number of shares in 2013, right? Which was 75 in this case, right? So your exercise in relation to this example was like that. Now let's get to class example 2 to look at this one, what has happened. So as we keep going with these exercises, we are adding things, right? It's the same exercise as the one that we were doing. Everything is still the same as class example 1, but now take note of the fact that now we've added this. It's still the same exercise. Now we've added something called a capitalization issue, right? Now I will explain to you a capitalization issue, and I will tell you what does it mean. Okay. All right. So since everything is still the same, let's get to this part here. You will notice that everything here that we calculated or how we are doing things is still the same. Look at the reconciliation of basic earnings, still the same. But what has changed is this calculation. This is the calculation that has changed. Right, this one here. I will explain to you what it means. Right. Now, we did this calculation up until here. In the previous example, we did it up until here. Right. Remember one thing, always follow the sequence of the dates. Do not skip and go from one date to the other without following the sequence. You'll see in the exercise. It's 1 July, then after July, there's August. So when you do it in that sequence. You deal with July, then you go to August, you deal with the issues as they are. Right. Now, this thing called the capitalization issue. It is shares issued for no value. So you've got a capitalization issue. You've got what we call a share split. And part of what we call rights issue. These three, this one, and this one. One thing that characterizes them is that shares are issued for no value, meaning no cash is received. Right. So there is a difference between the shares issued here and the shares issued here. The ones in July, we get money. The ones in August, we don't get money, except what happens is the number of shares increases or decreases, depending on what is being said in the questions. But there is no money that we are receiving here. There is no money that we are receiving. But then now, let's read this thing in August. It says, this one here. On 1 August 2014, a capitalization issue where one ordinary share became 5 ordinary shares took place. So these guys, in short, what they are saying, if you are holding one share, you will end up having 5. So in short, these guys are giving you 4 for free, because I'm holding 1, I will end up having 5. It means from my 1, they add 4, I will end up with 5. So the free shares, or the shares that are issued for no value, is 4. That's the statement. That's what they are saying in terms of this statement, that if you're holding 1 share, you will end up with 5. So from your 1, they add 4, you end up with 5. So the 4 is the one that is for free, right? Or for no value. Let me then get to this calculation, because the rest of the things are still the same. Now, we did the calculation in the past example until here, okay? Now, let's then get to interrogate this question. Let's look at the shares as they are here. So if I've got 95, 85, and 75 by this time, these guys are saying for 1 that I'm holding, I will end up with 5. So meaning they're giving me 4 for free. All right, let's test this thing. If I have 95, which is my actual, and they're going to give me 4 for free, if I multiply that by 4, it will give me this. You see, if I take 85, and I multiply it by 4, it gives me 340. You'll notice that. Also 75, if you multiply it by 4, it gives you 300. Right. Some people will then say, if you look at this calculation, 95 divided by 5, divide by 1, multiply by 5. So they want to know how many ones do I have, and I must end up with 475. So they will get this one first. And then they take the difference between 95 and 475. Right. You can still do it the same. You can say 85 divided by 1 times 5. It will give you this one here. And then you take the difference between 85 and 425. You can still do it like that. It's fine with me. Right. But now, one thing that I will advise you to do is that when reading these statements, like this one here, always make sure you understand what it says, because this one says 1 becomes 5. Others, they tell you about the ratio. So you will see, read it with understanding. It's not always the case that when it's a capitalization issue, it will say 1 becomes 5 or 2 becomes 3, whatever. No. They sometimes talk about the ratio. That for every 5 held, maybe you got so many shares. You see, that's a thing that you might come across in some of these exercises. You'll see they're not always the case. It's all the same. Now we get back to where we were. So now we know the number of shares. Now by end of this will be these ones, right? Now when you calculate your ordinary, here it is. You will see the profit is still the same, but the number of shares have changed because we've added a transaction in relation to this one. Okay. Now, dividends per share, here it is, right? But then you need to notice that since 2013 has changed from 75 that we knew before this capitalization issue it has become this one. Now it has been adjusted to this one. Now one of the most important rule when we are dealing with things like capitalization issue, share split, and rights issue is that when shares are issued for no value, meaning the free shares, you must always go back to the prior and fix it. You'll see this capitalization issue affects 2013. But if you go and check here, when did it happen? All right, when did it happen? 1 August 2014. Even though it happened in August 2014, you must still go to 2013, which is the prior, and fix it. That is the role in relation to when you are dealing with shares issued for no value, like capitalization issue, share split, and rights issue. You go back to the prior and fix it. So that is why you see here, you'll see there's a figure here for 2013 because this is the prior. It must be fixed. Because if shares are issued for no value, you must fix even the prior. Right. That is the impact in relation to this transaction. Now, once we are done with calculating the EPS, it must come here. Like I said, figures must not change. Okay. Your basic your dividends per share, here it is. The adjusted one is below. You'll see it's this one because you don't adjust the current, you only adjust the prior because of this thing of dealing here with the prior. Okay. Now you'll notice here you must tell us how did you calculate this. Right. So you'll notice something here. It is expanded. The basic earnings are still the same, and unweighted average number of shares 425 and 375, they come from this calculation here. Then now notice here it says after, right, remember you must in this note anything that you've touched that relates to no value, meaning whereby shares are issued for no value, you must talk about it in that note. Okay, after the capitalization issue on 1 August 2014. Then here's this thing that I was saying now. The basic earnings per share for 2013 had been adjusted accordingly. So they're saying you did come here and adjusted the figures. So the basic earnings per share for 2013 have been adjusted accordingly. Right, that's what I was explaining now, that if you've got shares issued for no value, like capitalization issue, share split, and part of the rights issue, you go back to the prior and you correct it. Okay, you fix the prior. All right. Now, we've dealt with this one, this exercise. So what now we need to do is to see that we have a situation of dealing with the next exercise, which is this one here. Notice that it's still the same thing, but we keep adding things on this exercise. Right. We keep adding things on this exercise. Let's see. There. Right. We keep adding. Now you'll see we've added this one. Here is the rights issue. Here is the rights issue. The question still remains the same. Nothing has changed except that now we've added something in this class exercise. Now let's get to this part. You'll see most of the things are still the same. Now I will get to what has changed. Right. It's a very good exercise. You'll notice that now what we did in the previous exercise, we stopped somewhere here in the previous exercise, right? So they've added something called a rights issue, right? They've added something called a rights issue. Let's deal with this thing. Here it is. Now, It says on 1 October 2014, the directors declared a rights issue of ordinary shares of 1 new ordinary share for every 5 ordinary shares held. This is what I was talking about when I was talking about the one in August, so that it's not always the case that it will say 1 becomes 5. You see, it can read like the one that is under rights issue, where they say 1 new ordinary share will be issued for every 5 that we are holding, right? And held on 30 September 2014 for 2 Rand per share. The fair value of the ordinary shares immediately before the rights issue was 5 Rand. Now, this is what you must always be careful of in this one. Your share is issued at 2 Rand, but the market value is 5. Now, you will notice that if that is the case, the share has been issued at less than fair value. One way or the other, some of the shares will be for value and others will be for no value. But I will show you what it means. All right. So if you're holding 5, you'll get 1 share. All right. Let's get to the calculation of the number of shares first. All right. We are sitting at this level here. All right. We are sitting at this level. Now, let's get to the dynamics in relations to this calculation, right? So the issue here is that if you check what these guys are saying, they're saying if you are holding 5, you will get 1 share, right? So we've got currently 475. Let's deal with this one here, and this number here. Right, we've got 475. You divide 475 by 5. Right, I'm holding 5. How many 5s do I have? 95. Times 1, because I'm going to get 1 share. Right, so you'll see when you look at this here, I think there's something not right here in terms of this calculation. No, it's correct. Right, it should have said it's done the other way around. It should have said 475 divided by 5 times 1 is 95. Right, I think that should be the case. Okay, it should be dealt with it in that fashion. It should say divide by 5 times 1, 95. Okay, then here let's then check again this one. It says no, it's correct, this one. It's correct, because it is the calculation that relates to capitalization issue. Let me leave this one. It's the one that says 1 became 5. No, that one is correct. Let's deal with this one here. The one that relates to rights issue, it's number 3. It's this one. Divide by 5 times here is 95. That's the one. That's the one that I was looking for. All right. So you've got 475 for every 5 held. For every 5, let me do this, held, you get 1 new. Right. So 95 new. These are the new ones in total. Right. Total number of shares that are new. Now, since there are 95 new shares, these shares were issued at 2 Rand. You see. But the market value is 5. Okay. So shares issued for value, they are 38 out of the 95. Let me explain this thing in another way. This one here. What I want you to do is you'll say there are 95 thousand shares. They are issued at 2 rand, right? Equals to, let's check how much is that. 95 times 2, it says 190, right? 190,000. Now the question arises, if you issued these shares at market value, how many shares do you need to get 190? Divide this by 5, right? 190,000 divided by 5. It tells you only needed to issue 38. Right. So you've got 95 new shares. They were issued at 2 rand. So the money that you got was 190. So the question is, if I issued these shares at 2 rand and I got 190, how many was I supposed to issue to get 190 if I stick to the market value? I only needed 38. That is why they're saying 38 is for value. From this 95, if 38 is for value, the other ones are for free, the 57. It's for no value. And remember what I said shares issued for no value, they affect the prior year. You must restate the prior year because they are for free. Now, let's then get back to the calculation. So you'll see this 38 plus the 57, they come from here. They are these ones here. Value, for value and no value. You see 38 and 57. In total, they add up to 95, which is the new shares that we issued. Okay. Now, let's deal with the 38. We deal with this one first, value, the one issued for value. These ones here are the same as these ones here. They are the same. You deal with them the same, like these ones. This is the same as this. You deal with them the same way. What you do, you look at the 38 and say, when was this thing done? According to the question, it said, I think 1 October. October, November, December. It's 3 months. Right, it's 3 months. Now, if you then say 38, I think I just need to add something here. About the 38, you should say 38, 1, 2, 3, multiply by 3 over 12. Let's see, equals to what? 38 multiply by 3 divided by 12. Yeah, 9,005, you see. It's 9.5, which is this one here. Right, because in 2014, the 38,000 shares were there for 3 months. Like I said, the way you deal with this one is the same as dealing with this one. It's the same thing. They are both for value. You received the money for them. So you look at when they were issued. So it's 38,000 times 3 over 12. It gives you the 9,500, which is this calculation that I've added here. Okay. Then you've done that. So you add and then you get these amounts. Right. Now we deal with these ones that are rights issued no value, the 57, this one here. Right. You can see it affects the prior. 2013 has been corrected. Okay. So now, what these guys are saying, they're saying, to calculate this number of shares, what you need to do, you need to say, look at this column. You will say, here it is the 57, which is for no value, divided by the total number of shares at that point in time. You multiply by this, will give you the 48, which is this one here. Shares for no value, divided by the total number of shares, multiplied by the weighted average number of shares at that time, they give you this 48. Okay, so it's this one that we are using. You say this divided by this, multiply by this, it gives you this one. Okay. Then for the next one in 2013, remember you must restate the prior year because these ones are for no value. This one here behaves the same in terms of how you deal with it like this one. Because both of them, they are for no value, you must touch the prior year. Right. So again, you say this divided by this, multiply by this, it will give you this one here. Okay, so you'll see we've also put it here for your purpose. Okay, then it gives us the new weighted average number of shares. Then those are the number of shares you'll see in this calculation that are being used. Okay, and you'll also notice that your 2013 dividends have been adjusted to this new actual number of shares. You'll see it here. It was 75, but now the number of shares have been adjusted to this one. They've changed. Okay, right. Now, once you are done with this calculation, you will disclose it here, and you'll also put your dividends here. You need to notice something. Dividends, you see dividends like this one is under statement of change in equity, and these ones are under the statement of profit or loss and other comprehensive income. You don't mix them. You don't put, if you take this one and you put it here, you are wrong. You don't get marks for that. If you take the one I've highlighted and you put it here, you are wrong. You don't get marks for that. Okay, you must know where things are going. Right. Now, your basic earnings, once you're done here, you must explain to us what happened. The profits, the calculation of basic earnings per share is based on earnings of 198 and 123, and on weighted average number of shares, which are from the calculation below. Shares in issue. Now remember what I said. I said if shares are issued for free or no value, you must talk about them here. You see, the first one that was for no value is capitalization issue. The second one is rights issue. Remember, the rights issue has got a portion. That is for no value here. So I must talk about this. Right. And then you see the basic earnings per share for 2018 have been adjusted accordingly. Remember, I said that capitalization issues for no value, you must fix your prior. Rights issue, no value, you must fix your prior. You must tell us here in the note that I did fix the prior. Okay. So those are the basics in relation to EPS currently. Thank you.